2025 is almost over, which means soon there will be very little you can do to reduce your taxes for the year. But right now, we still have time. Not a lot of time, but if you act right now, you can potentially cut thousands of dollars off your next tax bill. So in this video, I am going to give you 3 quick, easy, and effective tax strategies that you may be able to use to instantly reduce your 2025 taxes as a licensed CPA that tax plans every day at mycpacoach.com. So go ahead and like and save this video, and let's go ahead and jump right in. All right, number 1, IRAs, which stands for Individual Retirement Accounts. And guess what? Literally anyone with earned income can set this up at almost any brokerage of their choice, like Fidelity, Vanguard, and so on. And to be clear, you do not need a job, an employer, or a business to offer this to you in order to set this up. This is not a 401k, this is an IRA. Now, here's how IRAs work. In 2025, you can contribute up to $7,000 to a traditional IRA, or $8,000 if you're over the age of 50. And when you do that, you can receive a tax deduction against your contribution. For example, someone in a 22% tax bracket might save $1,500 in taxes by simply moving $7,000 into their traditional IRA. And this is per person, okay? So if you have a spouse that works, you can get another $7,000 to $8,000 into their IRA. People even set this up for their kids when their kids have earned income, which may allow your child to get another $7,000 into their own IRA. And once those accounts are funded, you can then make investments from those accounts into various assets like your favorite stocks, index funds, bonds, CDs, and other assets of your choice to build wealth. Then as those investments grow in value or generate income, you would owe no tax on those gains. All of your taxes would be deferred in these accounts and would only be triggered when you start withdrawing funds from them when you reach retirement age. So if you are in a high tax bracket today and expect to be in a lower tax bracket when you retire, you will instantly reduce your taxes by simply moving funds into a traditional IRA. However, there is one big caveat to IRAs that you must know, which is the fact that your deduction can be limited or disallowed altogether if you are covered by a workplace retirement plan, such as a 401k, for example. If you are, then your deduction is only allowed if you earn below a certain amount of income. So if you have a 401k plan through your business or an employer, be very careful here and make sure you check with your CPA to see if you actually qualify for this. But that actually leads us to strategy number 2, maxing out your 401k, which is very similar to an IRA, except the fact that a 401k is an employer-sponsored plan, meaning that this must be set up through a business that you own or work for as an employee. And if you're looking to reduce your 2025 taxes, then you should be looking at setting up a traditional 401k, which grants you a tax deduction for every dollar you put into it up to a certain limit. As an employee, you can typically defer up to $23,500 of your wages, or $31,000 if you're above the age of 50, into a traditional 401k account. And just for context here, a $31,000 pre-tax deduction like this would save someone in a 37% tax bracket over $11,000 in taxes. And again, if you have a spouse, they might also be able to do the same exact thing here if they have earned income and a 401k plan that they have access to. Now, for some of my clients, we even set up business structures that allow them to set up their own 401k plans through their own business, allowing them to set up 401k plans for themselves, their spouse, and even their children to save even more money in taxes. Not to mention the fact that when you have your own business, you're also able to get anywhere from 2 to 3 times more money into your 401k because the business can also contribute to your 401k as well. For example, with a solo 401k, the business is able to contribute up to 25% of your income or wages towards your 401k. And that is in addition to the employee limits that we just discussed. So someone with a $100,000 W-2 from their business may be able to put up to $31,000 into their 401k as an employee, plus another $25,000 from their business, giving them a total deduction of $56,000, which would save someone in a 37% tax bracket over $20,000 in taxes alone. And that's just one type of retirement plan. But there are several other structures that may allow you to do even more than this through things like pensions and defined benefit plans, for example. But that is honestly beyond the scope of this video, so just comment pension below if you want to learn more about that. Now let's move on to another easy account that you may be able to use that a lot of people actually miss out on, which is number 3, maxing out your HSA, which is a health savings account, which has even better tax benefits than retirement accounts in my opinion. And that is because HSAs are one of the only types of accounts that grants you a tax deduction for putting money into it and allows your proceeds to grow tax-free in the account when invested, and it allows you to withdraw the proceeds tax-free when you use it for qualifying expenses. Literally no other tax advantage account grants all 3 of these tax benefits at the same time. And that is why these accounts are so powerful. And even better, now there are places where you can set this up for free on your own with or without a business. To qualify for an HSA, all you need is a high deductible health insurance plan, which most plans actually are these days. For the 2025 tax year, a high deductible health plan is one that has a minimum deductible of $1,650 for a plan with self-only coverage, or $3,300 for family coverage. And if your plan qualifies, you could set up an HSA and contribute anywhere from $4,300 to $8,500 depending on the type of coverage you have. Then, similar to the other accounts that we discussed, you can invest those funds into other assets and receive tax-free investment growth when those investments generate income. But unlike those other accounts, if you withdraw funds to pay for qualified health expenses, those funds will come out tax-free, which is a very nice feature to have here. Now, as a CPA, I have seen people use HSAs for all sorts of things: doctor visits, dental procedures, prescription drugs, eyeglasses, and even things like sunscreen. And if you want an in-depth guide on that, just comment HSA below. But from a tax perspective, an HSA can easily save you a couple $1,000s in taxes. Now, depending on your unique situation, there may be far more you can do to reduce your taxes before 2025 ends, especially if you own a business, own real estate, or have an active trade. And if that's you, I have already published separate video guides that cover year-end tax strategies for those situations. So make sure you subscribe to the channel and check out those videos as soon as possible. And if your CPA is not helping you implement strategies like this to keep your taxes down, just apply to work with my team today at mycpacoach.com.